Hello, fellow Rebel Capitalists. Hope you're well. I am back with my good buddy Keith Weiner from Monetary Metals. They've been nice enough to sponsor the show for the last couple months, but that's not really what I want to talk about today. What I want to discuss is the gold silver ratio, because as we all know, gold has been skyrocketing. It's up, I don't know, where is maybe 3,400. And the gold miners and silver, although silver has really caught up lately, it hasn't gone to the extremes that we have seen in past cycles. So I wanted to get an expert on here to discuss what he thinks the future is for silver, and maybe why in the past the gold silver ratio is a thing mechanically, and why we may or may not see that play out in the future. So thanks for coming on such short notice, Mr. Keith Weiner.
Thanks for having me, George.
Okay, so why don't you go ahead and just explain your views on the gold silver ratio in the past and what you see for the gold silver ratio moving forward?
So we measure something called the gold basis, which is essentially a measure of abundance or scarcity. And for the longest time, including now, silver is just more abundant to the market than gold. And so that's, I guess, a fancy way of saying supply and demand fundamentals for silver just haven't been and just aren't today as strong as they've been in gold. But we have a unique way of measuring it that I think is kind of objective, and it takes out all the all the rumors. India is buying, or this country is buying, or silver mine production is up, or there's going to be new applications for silver as an antimicrobial or whatever, all of which may or may not be true, all of which may or may not be long factored into the price. But the basis is measuring current supply and demand conditions to the market. And silver, just for the longest time, so I wrote or at least a section of the annual gold market outlook report in late January. And I said, we could see 3,600 in gold this year. And if that happens, we may see $37 in silver. Just not, like new record highs in gold, and nothing like that at all in silver. Obviously, I assume everybody knows silver hit almost $50 in 1980, and it hit almost $50 again in 2011. And here we are at 36, wondering what the hell is going on. A lot of people think that silver has been quote unquote demonetized. I'm not one of them. I actually think silver still has very high stocks to flows. That is, enormous amounts of silver have been accumulated without the intent to consume it. That is, people stack it. Silver does have a industrial component to its demand. And I have to imagine that along with everything else in the real economy, that's got to be soft right now. But the monetary component is the one that I think is important and, if not troubling, at least concerning. And that is, it's always been the case for thousands of years. Silver is the working man's monetary metal. If you're working for, let's say you're a skilled wage earner, and you're today you'd be a senior machinist, master plumber or something like that. You're taking home, X dollars a week, and you want to put 10% of that into metal for savings. Well, in gold, you've got a very, very small amount, and you're going to get killed on the product premiums for really small size, bars like that. Not even bars, little wafers. The silver, you kind of get a small handful of silver that's much more heftable. It has that emotional appeal, and it's much more efficient to buy, $50, $75 worth of silver versus $50 or $75 worth of gold in terms of the bid-ask spread. So, silver is what's stacked by wage earners. Gold is a capital asset, and it trades against other capital assets. Obviously stocks, bonds, real estate, whiskey, artwork, Bitcoin, whatever. All these are capital assets, and they're not necessarily the wage earner class. That's the capital owning class participating there. So that's been the story in silver for the last X number of years. And unfortunately, that's led to $36 silver, and we hit, I think, $3,500 in gold not too long ago. We're down from the highs at the moment. And there's central bank buying of gold, but of course everyone knows central banks don't buy silver. It's a different market. when you see a large family office with a couple of billion AUM, sometimes maybe they might have a silver play in mind, but it's much more likely to be gold.
That makes a lot of sense. So the last cycle I looked at for one of my videos was 2008, 2009, going into 2011, when you said silver hit $50 an ounce. And I remember in 2008, gold really crashed right around Lehman, I think it was, or maybe Bear Stearns, because we had
Yeah.
a big liquidity event. And then the Fed comes in with quantitative easing. Gold just rips higher to, at the time, was an all-time high in 2011. And in 2008, 2009, the gold silver ratio was, I can't remember exactly what it was, but the bottom line is during 2010 and 2011, gold went up by like 100%, but silver went up like 4x in that,
Mm-hmm.
especially that last year. I mean, it went parabolic. So you just explained why we likely saw that. But do you think we're going to see those same dynamics play out into the future? And one thing I'd like to get your opinion on is, do you think the average working man, instead of playing this through silver like they have in the past, might play it through crypto? Because they can buy $50 worth of crypto or $75 worth of crypto, and they don't have to pay really any spread, maybe a slight spread if they're buying it through an ETF or something like that.
Right. So I think, number one, it needs to be said, I think we're in a completely different market dynamic than 2009 to 2011. At that time, the prevailing story amongst not just, the gold bugs, but let's say alternative finance, was hyperinflation was coming. The government was going to print so much money with QE. We're going to have hyperinflation. And I remember saying at the time, guys, this isn't going to work that way. And I have concerns that, when everybody realizes we don't have the hyperinflation that everyone expected, there's going to be a lot of selling of precious metals, which is what happened. So I think the driver today for why people are buying gold isn't expectations of imminent hyperinflation, which I think it was in that 2009 to 2011 period. Number two, in silver, I think you had something that was unique that isn't going to recur. So the gold silver ratio hit its all-time, or not all-time low, but it's low for that cycle of 30. And today here we are at like 95. So silver was 3 times more valuable against gold then versus what it is today at the moment. I think part of that, I mean, obviously there was buying hyperinflation, but I think part of that was the banks had got themselves wrong-sided on a trade. Not that they were naked short. I think I've probably done more than anybody to write to debunk this idea that the banks have a naked short speculation against any metal, but rather duration mismatch. That they had, they had silver assets that were longer maturities. They had silver liabilities, i.e., short futures that were shorter, so that they, thought they were hedged. But all of a sudden, a couple of demands for delivery, and they got themselves upside down and inside out.
Silicon Valley Bank.
Right. But 2009 version, to 2011. But actually, that didn't happen in 2009. Excuse me. That happened in second half of 2010 through first half of 2011, and then silver crashed after around April. Right. So it was a short-lived, but that was that parabolic spike. I think had to do with sort of mismatch of the duration of their asset and liability. Something tells me the banks learned their lesson from that. Probably not going to recur. So anybody hoping for that, at least that driver is off the table. Now, what I do think is on the table, and why I think we have a durable bull market. This is not the sell the blips, endless bear market of second half of 2011 through 2018, 2019, is more and more people kind of realizing that the paper currencies are doomed. I mean, there's no way to look at it if you think about it at all, no matter what your theory, whether you're monetarist, Keynesian, Austrian, new Austrian as I am. There's no way to look at it and say, yeah, dollar's fine, the data's fine, the currency's fine, it's all fine. It's all versions of that dog sitting in that room with the flame saying it's fine. It's not fine, and people realize that. And then when you look at the other currencies are even worse. Right? So people are coming to precious metals saying, I want to have durable, not a trade. Not I'm going to buy gold because it's going to go up from 23 whatever, it's at 25, whatever, take a $200 profit. But I want to hold this as a long-term thing because of the uncertainty of what could happen with the debt, what could happen with the dollar, the charade of endless, we're going to cut spending, and now we're looking at $2 trillion deficits. Oh yeah, let's reset the debt limit again for the 74th or 75th reset of the debt limit. I mean, it's a joke. So people are looking at this, and I think that will ultimately impact both metals. One other thing worth saying about, has silver been demonetized? I was a presenter at a conference on a panel, mostly talking about gold, but somebody else was talking about silver. And he looked at silver and he said, we wanted to see what silver was correlated with. And so they looked at crude oil, they looked at copper, they looked at various other things, and they looked at gold. And as soon as he said that, I'm like, I know what the answer is going to be. And silver did not correlate particularly well with any commodity, including especially copper. I shouldn't say especially, but including, maybe surprising to some people in the audience, copper. It correlated most highly with gold. So gold and silver tend to move together, although silver has really lagged, I think, for the reasons I've outlined. But could there be a catch up? Yes. Now, we, in addition to tracking the basis of the metals, we also have a model that we try to calculate what we call the fundamental price. The first caveat I give, a guy named George Box, who is a statistician, said, all models are wrong, some models are useful. We have a model. What the model tries to do is back out the price effects of the speculators in the futures market, because they have access to 20-to-1 leverage. They can really move the price around in the short term. So, okay, where would the metal be clearing if you didn't have a futures market and you didn't have leverage? That's what we're trying to calculate in our model. And we look at a variety of things, including interest rates and the basis spread. And our fundamental model says that the gold-silver ratio should actually be a bit higher than the current market, that it should be in the 98.5 range. And so it's not saying, oh yeah, that should be 50 or let alone 30. It's saying, yeah, it should actually probably be a few ticks higher than it is. And so that's the reality of where we're at. Now, could it take fire? Yes. Could family offices and sophisticated institutional investors decide to buy silver? They could. Obviously, silver is a much smaller market. It wouldn't take too much of that to drive the price, bananas. But what's the catalyst for that? When gold is, so much more the no-brainer, choice. That's what remains to be seen.
So how is your analysis coming to that conclusion, Keith, that the gold-silver ratio won't, let's just say, mean revert? What is it about the fundamentals of silver right now that makes this time unique, and why your models are saying the gold-silver ratio should actually be a little bit higher than it is, not,
so
substantially lower?
The one thing that I have to emphasize, this is just a snapshot of supply and demand conditions as they exist in this moment.
Okay.
And it doesn't say that it couldn't change tomorrow or next week or next month, and probably will. Maybe for the gold-silver ratio to go higher, maybe for it to go lower, maybe for it to just move around sideways and oscillate in a little sinusoid pattern or whatever. But at this moment in time, what it's really trying to measure is, demand for metal versus demand for, leveraged paper. It's comparing those two and comparing interest rates and a bunch of other stuff. We put out white papers on what we're doing with this model and why. But it's just a snapshot of this moment in time. It's not really a macro model that's trying to say this is where it's all going to go. But if the model differs significantly from current market price, it's suggesting that there's a tension. And I liken it to, imagine you have two steel posts and you have a rubber band stretched between. And sometimes the market is a little depressive and someone's pushing down on that rubber band. Mm-hmm. And other times the market is manic and someone's pulling up on it. You want to kind of measure how, if the rubber band is flat, how distended is it in one direction or the other? And then, sort of getting a sense of the tension. It gives you an idea if you want to place a bet, which direction you should place it in and how much tension there is. Therefore, the likelihood that bet is going to work out, and also the likely timing. The more stretched that rubber band is, the more that it'll be hard to maintain that tension. And so right now there's a slight bit of tension and the gold silver ratio higher for whatever that may be worth. That could change. The model's not saying that it won't, but that's this moment, in time.
So if I hear you correctly, you're saying for Keith's personal portfolio, he's not rushing out to buy silver right now just because this gold silver ratio is at an extreme. If he's going to allocate capital, he would prefer to allocate capital directly to gold because he thinks the fundamental drivers are better for gold, not just right now, but maybe, over the next year or two.
Well, next year or two, different story. But yeah, I think my macro call also is congruent with that. That yes, because the wage earner is under enormous pressure because industrial demand is likely to remain soft. That yeah, probably going forward, you're not likely to see a gold silver ratio of 50, in the next year or two. Could it hit 80? I mean, yeah, sure, of course. Could it hit 105? Yeah, it could. Could it hit 120 again? Maybe. The fundamentals aren't that bad at the moment, but we'll have to see which direction this goes in. Now, if there really is to be peace here with Iran and Israel at the moment, I'm in Dubai at the moment. There's a general feeling that there's going to be kind of a sigh of relief boom as everyone is going to go travel and shopping and whatever, so we could see it pick up in consumer spending, GDP, all the rest of the oil certainly and other commodities, and maybe silver benefits from that, and we see a blip to 37 or 39 or 40. Sure, that's all possible. But fundamentals at the moment, it is what it is.
Yeah, that makes a lot of sense. So, what do you think about the argument that crypto is? Let's assume that we go through that these fundamentals kind of wash out in favor of silver over the next few months, and the retail, the average Joe and Jane, the wage earner out there now wants to get on board with precious metals. And they look at gold, and to your point, they're like, "Yeah, I'd like to buy it, but the spread's a little much if I'm only allocating a couple $100. But now instead of silver, I have the option of going into crypto." So do you think that that is a headwind for the gold silver ratio getting back to, let's just say, 50?
I don't, and I kind of have a radical theory that may be controversial, and that is I don't think one asset class really competes with another in that sense.
Okay.
Because if you look at let's say the stock market, it's not like people buying Microsoft mean that Google has to go down. They all tend to go up together, all tend to go down together in response to sort of a broader credit cycle. Whoever's buying Bitcoin, there's a seller on the other side. Yeah, there's a little bit of mining, but I think compared to the size of the Bitcoin market today, the mining is relatively small, which means someone who'd been holding it just sold. Now, so okay, the buyer didn't buy silver, he bought Bitcoin, but now the seller of the Bitcoin is buying what?
Right.
Probably not dollars, right? So I think that's just a wash. They go in and out of Bitcoin. Maybe they do. In the rest of the world, it's so easy. If you just get immersed in FinTwit, or if you're a millennial, which I'm not, kind of a tech bro, you tend to assume, well, that's the whole world is doing this, and then you come out and you look at the Grand Bazaar in Istanbul. You come to the Gold Souk in Dubai or any of the shopping malls here. You go into India, you go into Singapore, and the massive crowds and activity around precious metals is completely, you couldn't even imagine it unless you were here seeing it.
Right.
And I think Bitcoin is a very small, blip against that. So somebody told me recently, interesting statistic. This is a company we work with. There's a Turkish company. The population of Turkey is what, 85 million or something. There's 110 million gold-denominated bank accounts in Turkey. So they have bank accounts like Americans have guns or TVs. There's more accounts, gold accounts, than there are people, right? And let alone that obviously newborn babies, count in the population statistic, but probably not in the gold account statistic. So it's a place where everybody has gold. In India, even the people that don't have enough food to eat have gold. It's just a different, thing. And if they can't get gold, these places also have an affinity to silver to varying degrees. China, Turkey, the Arab world, India, and No, I don't think Bitcoin really, dissuades anybody, from precious metals. I think it's another asset. People are buying it. Obviously, if you read any of my tweets, I'm not a particularly big fan. I guess one thing I just want to say now that you've given me a bully pulpit here, my position isn't that Bitcoin price has to go down. I'm not kind of the Peter Schiff camp that, okay, it's a bad asset, therefore its price has to be zero soon. My position is it doesn't work as money because it's too damn volatile. So if you have a long time horizon and you want to take a view as a speculator, have at it. But don't tell me it's money. Don't tell me it replaces finance or anything like that. That's what it doesn't do. But people are having at it right now. Bitcoin's what, 107,000 the last time I looked. And who knows? It could be 170,000 or 1.7 million. But every time someone's buying and bidding it up, someone else is selling. And what are the sellers buying? And recently there was a talk by one of the guys from Tether who said, they're increasingly a fan of gold, and he actually called it natural Bitcoin. For April Fools, I had called gold analog Bitcoin. So yeah, it's out there. People are buying it, but people, for every buyer, there's a seller, and what is the seller buying, right? So that's
Yeah.
it.
So, I mean, I'll say something, I guess, extremely controversial is when I think of currency or what people use as money, I first and foremost think of it through the lens of utility. And there are trade-offs with utility. And it's very rare, I don't even know if it's possible, for the best store of value to have the highest utility. Because if it's a store of value, then it's by definition scarce. And if it isn't a very good store of value, then people are going to hoard it. And that is going to decrease the utility of the currency itself, because to maximize the utility, you have to have something that easily circulates. And not just from a logistics standpoint, but where people are willing to circulate it and people aren't hoarding it. And so the better the store of value it is, the more it kind of loses that type of utility. So it's a trade-off. Then you also don't want a currency that's hyperinflating either, because then it's losing utility in a different way. So, and the reason I say that is because a lot of people just assume that money or whatever you want to call it has to be the best store of value, and that's what the free market would gravitate to. And I don't know that that's true. And the best example I can give you is when I went across Argentina, just trying to use nothing but gold, silver, and Bitcoin. What most of the Argentinians wanted was their depreciating currency that was depreciating by 20% per month, by the way. And why was that? It was suboptimal for sure, but for them at the time, it had more utility than the gold or the silver or the Bitcoin, even though those were, even they would admit that those are far better stores of value, but they didn't have the utility. And a lot of that goes into the network, which I think the dollar is the greatest network. It is flawed, of course, but I think it's the greatest network we've ever seen in human history. And that plays into the utility. So my point here is just to say that when we're looking at the form of currency or money that the free market would likely gravitate towards, the utility in and of itself isn't just about a store of value. There are a lot more things that go into it.
I'll take that as a softball pitch for what we do. If there wasn't interest offered on gold, the gold never circulates, and that's exactly where we're at today. I can't tell you how many, I call them Gold 2.0 companies, have come out with a way to use gold for payments, and they build the payment rails, they get the licenses through money transmitter business, they do all these things, and they find that nobody actually wants to pay out their gold. A lot of people will be happy to be paid in gold, but nobody wants to pay out.
Right.
They want to pay the paper because the paper is falling in value. It's only interest that will draw the gold into the market. And I agree with you. I think money is the most marketable, i.e., narrowest spread commodity. Currency is the most marketable credit. and currency can have a spread of zero, which is what the dollar is, right? There's no spread. It's bought and sold, it's accepted and paid at the same par. Dollars just transmit essentially frictionlessly. I mean, merchants pay, but if you have a dollar and you want to spend it, it spends as a dollar with no spread whatsoever. And that's never been true for gold unless governments try to subsidize it. In the US, they said you can bring in your gold and we'll turn it into coinage with zero seigniorage. It's a subsidy at taxpayer expense.
Right.
But other than that, yeah, there is a spread. And but the paper, whether it be gold redeemable paper, which is what I think it should be, or whether it be irredeemable paper, which is what we have today, is more friction free, and therefore that's what circulates. And in Argentina, I'm going to assume that the average person there is not in a position to have a lot of savings. Their income, they're spending it as fast as they're making it. So of course they want it in the local currency because that's what they spend, right, to buy food. And that's if they have employees, they're paying wages in it. If they have debts, that's what they're paying to service the debts. And that's what they need. If there's anything left over at the end of the month, that could be 1% or a fraction of a percentage point. Maybe that's what they'd want to hold in something other than pesos.
Yeah, but that's when they go to dollars, Keith.
Right, hold dollars.
Yeah, because again, is the dollar a better store of value than gold or Bitcoin? No, absolutely not. And the Argentinians would not say that it is. But again, it has more utility in other ways that the store of value might not have, to where they put a higher value, I guess, for lack of a better word, on that dollar for savings than they would for a gold coin or something like that. And it's not that they're stupid. When I was there, I was live streaming everything. And then when I got back and I got done, I was reporting on what we saw, or people watched the videos, and they just said, well, these Argentinians, well, they're just stupid. No, they're not stupid. No. They're extremely intelligent people. And they've been dealing with hyperinflation for what, 10 years? And the bottom line is this is the conclusion they've come to. I guess it's a lot better now, obviously, but back then this was before Malay. And this is the best system that they came up with. So I would argue that if we had the same type of inflation in the United States, that people would be doing the exact same thing. Their number one would still be the dollar, even if it was depreciating by 20% per month. And then, that's what's actually fortunate for the rest of the world. Now that I'm thinking about this out loud here, is that they do have the dollar. The Americans don't have the dollar, right? From a standpoint of it being a better store of value than the currency that their expenses are denominated in. So the Americans have gold and silver, but then you have the utility issue that you're referring to. They don't have that other currency that they can go to, that although it may be losing value, it's losing a hell of a lot less value, and it has extreme utility and fungibility for anyone that they want to transact with.
There's a certain irony to me watching Malay as he, was running for election and got elected, and various advisors, some of whom I know, relatively well, advising him to dollarize. And the same libertarians in the U.S. hate the Fed. You're wearing an "End the Fed" cap. All this stuff, right? The dollar sucks. Dollar's terrible. It's going to hyperinflate tomorrow. Are cheering him to dollarize.
Yeah.
And I'm like, one is when you have your abstract, idealist thinking cap on, and the other is when you're looking at the practical reality. It's a dollar world. And my argument is all the other currencies are dollar derivatives, number one, and number two, they're largely local. It's like a company coal mining town. They issued a paper scrip, and maybe some of the coal miners, families who lived in that town thought, oh yeah, our company, is so big, this is going to displace the dollar one day, or whatever they might have believed. But so provincial, right, compared to the reality of the prevailing dollar, and that's what the other currencies are. Mm-hmm. And I had Jeff Snyder on my podcast a while back, and we were talking about, and I said this, and he said, do you know what, because most of the derivatives, there's about $750 billion of derivatives out there. Most of the derivatives are either interest rate hedges or currency hedges. Do you know what percentage of derivatives out there have the dollar on at least one side?
And 90%.
I said it's got to be over 90%. He said it's over 99%.
Yeah.
It's like there's the dollar and there's everything else combined is a tiny. So if you look at it as a flotilla, the dollar is the aircraft carrier, and everything else, you have an inner tube, you have an air mattress, you have like a half rotten log, you have a kayak. You know, it's like you have a guy holding a couple of balloons. You know, they're all like in aggregate, they don't have the mass to challenge the dollar in any way.
Yeah, and it's unfortunate. It's not that I like it. It's just a statement of objective fact. It's not that I'm like rah the dollar, rah U.S. government. Everyone knows that I'm as anti-government as anyone that you'll talk to, outside of maybe my good friend Doug Casey. But it's just the dynamics of the monetary system. It is what it is.
That's right. And if sometimes people accuse me of being a shell for the Fed, I'm like, do you not have Google? Do you not have Google in your parts? You know, right. But if you want to be kind of like an oncologist or pathologist, and you want to study like cancerous disease tissue, you have to be able to describe it objectively and say, like, this isn't what I want, but this is what it is. This patient has cancer.
Yeah.
Right. And we got to understand that if we're going to have any chance to, combat it. And so I think interest on gold is the key to the whole thing. And then people will choose gold and it will have that utility. Gold did have the utility once. Now, not that the coins did circulate, but to your point, banknotes were preferred to circulate,
right?
Because it had less friction. But they were gold backed, banknotes that were redeemable in gold. And I don't think anybody would take, if you had a choice of two pieces of paper, and one is redeemable for a fixed amount of gold on demand, no questions asked, and the other is irredeemable, I don't think there's any question as to which would be preferred. But to get to that point where you have zero friction gold-backed paper is, there's a world of work ahead of us to get to that point.
Keith, in your world or in your ideal, and again, there's no perfect scenario because we're imperfect human beings in an imperfect world. So therefore, whatever monetary system we have is always going to be imperfect. But do you think a better system would be what we saw in the late 1800s, where we had free banking? So the government, there was no Federal Reserve, and the government was as out of the monetary system, at least domestically in the United States, as possible. And you did have that gold redemption component, but then you did have the banks with the ability to expand or contract the money supply based on lending or paying off those loans. Do you think that would be optimal, or do you see it a different way?
Yeah. So in the U.S., it wasn't exactly a free banking system, in that to issue notes, the banks after, when was it, around the Civil War era, had to have a national charter, and to get the national charter, they had to back the notes with U.S. Treasury bonds.
Mm-hmm.
So as the U.S. Treasury, so post-war, the U.S. Treasury was paying off its debt, was forcing a shrinkage of the quantity of notes in circulation, which caused all kinds of problems, shortages of currency and little banking panics and other things. Canada had a freer system, and it didn't have the panics and depressions that the U.S. had. But Canada, even then, wasn't as free as what Scotland had been in the previous era, which was, I think, a true free banking system.
And
so, yeah, I'd like to see.
And with Scotland, Keith, was that redeemable for gold?
Yeah, absolutely.
Okay.
So I would like to see a free market in money and credit with not only no central bank, but no laws forcing banks to stuff themselves with state government bonds,
Right.
as they did during the state charter era. No laws forcing them to stuff themselves with federal government bonds. And there were, other interferences as well. For the longest time, the U.S. government maintained a peg between silver and gold. And that caused all manner of problems. And then when they demonetized silver, so during the Civil War, they suspended specie altogether. Although I think, if I remember right, you had to pay, don't quote me on this, I might be wrong, but I think you had to pay your taxes in metal. But, the notes weren't redeemable in metal during that time. After the Civil War, there was all this debate about should we return back to a metallic standard. At that time, the belief was, yes, we should. 1873, post-Civil War era, they, reintroduced specie again, but no $1 silver coin anymore. So that was called the crime of 73. And people were really, really angry because think of the farmers and the craftsmen. They had debts denominated in dollars, which now had to be paid in gold, but they had savings in the form of silver, which is now losing its value rapidly through that era. They were pissed. That was a robbery in broad daylight, to say the least. So that sentiment didn't go away, for 20 some odd years, and that culminates in William Jennings Bryan versus McKinley in 1896. And William Jennings Bryan did not crucify this country on the cross of gold.
Right.
Was that, right? So he loses. McKinley, gold standard guy, Wall Street, New York, et cetera, wins. Now, William Jennings Bryan doesn't go gently into this good night. No, he shows up in the Woodrow Wilson administration, and he was the instrumental guy for passing the Federal Reserve Act, saying if I can't get some inflationary relief for the farmers with silver, I'll get it with paper. And then unleashes the Federal Reserve and builds a political coalition to make that happen. All of this, you could trace that to 1873, which you could ultimately trace to Alexander Hamilton deciding to fix silver to gold. Whenever the government tries to fix the price of two different things together, no good will ever come of it.
It always ends poorly.
One of them is overvalued, one of them is undervalued. Initially, gold was undervalued, so we're on a de facto silver standard from 1790. And then 1834, the next coinage act reversed it, and then silver is undervalued, gold is slightly overvalued, so gold circulates, we're on a gold standard, silver disappears, and then we demonetize it. It's just all these gyrations, and people getting hurt every time the government changes, the regime slightly. Whoever was banking on it being the way it was suddenly gets creamed. And that happened, many times in a row, and you had a lot of anger build up. And this is socialism, like angry factions having group, warfare, one faction against another, class warfare, right? And this is the origin of it, and one of the origins of it in the U.S.
That's really interesting. That timeline and how you connected those dots. What do you think the free market would gravitate, assuming we could get the government out of it? It was gold backed, like you're saying, kind of your perfect scenario. Do you think the free market would gravitate toward full reserve or fractional reserve? And when I say full reserve, I'm talking about just time deposits, and so the bank could basically match up their assets and liabilities. So if they were lending that out, you would have to have a contractual obligation with the bank that they can take your money for 3 years, and they take that money, and that's what they're lending out. So you do have the circulation of credit. But what do you think would be optimal, and what do you think the free market would choose?
So there was an instrument in the 19th century that was pretty much killed in World War I, and never they had a alleged gold standard after the end of World War I, but they never really returned to what it had been previously, and that's the bill. So the bill was it was credit, but it wasn't lending. The bill was clearing credit for let's say for any fast moving commodity with predictable and urgent consumer demand. So the farmer sells wheat to the miller grinds it into flour, sells flour to the baker, right? So the commodity is flowing in one direction, but the gold coin is flowing in the other direction, right? So the farmer doesn't have the gold coin, the miller doesn't have the gold coin, the baker doesn't have the gold coin until the consumer buys the bread. And then the gold coin can go in the other direction. So you need like 90-day clearing credit. That's what the bill was.
Oh, okay.
So at that time, it was widely done, and it was perfectly sound to back demand deposits with like 10% metal, in the vault, for redemptions or whatever, and 90% bills, all of which are going to redeem in less than 90 days. Bills are self-liquidating. A bond is not self-liquidating, but a bill is, because when the commodity is sold through, the credit is repaid. The average is obviously 45 days, if not less. And so there's a scene, I think it was in Walter Bagehot wrote a book called Lombard Street about banking in London at that time. And there's an old banker taking a young banker, kind of mentoring him, taking him under his wing. And he says, boy, the banking business, a simple business, provided you can tell a bill from a mortgage. In other words, if you try to stuff your balance sheet, if you're running demand deposit accounts and you try to stuff your balance sheet with bonds, you're going to get killed.
Right.
Because that's
Maturity
duration mismatch, fractional reserve, all that stuff. If it's bills, it's fine. And banks were doing that, and as long as there's no bailout, as long as there's no moral hazard, as long as there's no deposit insurance and macro prudential regulation, all these things, one thing stacked up on top of another, to create bigger and bigger crony banks.
Yeah.
That the smaller and smaller banks are not viable in this environment, and then you get all kinds of unhealthy, disease type behaviors. But as long as it's a free market, then any bank that was unsound would quickly get killed, which means the owners of the bank are going to say, let's run this as a sound institution. Let's not be unsound. And they would rediscover, I think they'd rediscover fairly quickly how bills worked, why they worked that way. I hope to see, and basically, as long as people are free, nothing can, the distortion, if there's a mistake that's made, it kind of distorts the fabric of the market in a certain sense. The distortion can't build and build and build and stretch and stretch and stretch until it tears the whole thing, and we call it a crisis.
Right.
In a free market, everybody's going to naturally shy away from that. It's only when the government is forcing that stretch, that distortion, that it gets worse and then they subsidize it, and then they give the moral hazard and the bailouts and the deposit insurance, and they just encourage it to grow like a cancer. And that's where we are, obviously today. And is the free market perfect? Well, in a certain sense, there's nothing more perfect than allowing people to choose how their own, how to spend their own money, how to work, what to work for, what price to set. Do they make mistakes? Of course they do. But then the mistakes are self-correcting, and the people who make the mistakes are punished, and the people who don't make mistakes are rewarded. I heard I don't remember who said this. It might have been Hugh Hendry, but it might not be. Who said that capitalism without bankruptcy is like Christianity without hell.
I think that was Milton Friedman.
Did he say that?
I think that might have been Friedman. Although that is something you would say.
Yeah, he might have repeated it. Maybe Friedman said it first, 50 years ago or whatever. But the concept is sound, right? It's like, let people experiment and do what they want. Let the entrepreneurs take the risk. Now, the other thing about banking that people need to understand is that the depositors were the most senior creditors to the bank, right? So a bank starts out by raising equity capital. That's the first thing that's lost if there's a problem. Then they also raise, long-term capital with bonds usually. That's the second thing that's lost. So as long as the bank is honestly reporting and you don't have all the distortions today, I still remember, and I consider Steve Forbes to be a friend, but he was a prominent advocate of ending mark-to-market accounting, 2009. I'm like, no good is going to come of this. You're writing something on your books which isn't true, right? So as long as the accounting is honest, as long as the accounting profession kind of stands as a guardian, maybe this is a quaint 19th century antique notion of honor and your word is your bond and all that. But as long as the accounting is honest and the accounting profession will keep them honest, then if a bank is getting into trouble, it's going to eat into its equity capital cushion, probably not impact the bondholders, and definitely not impact the depositors. And the bank would be wound up and liquidated. The depositors would be whole. The equity holders might be, might lose 50% or maybe even lose 100%. That's fine, right? And that's what's going to allow experimentation and risk-taking and exploring different models. And maybe there's another model that's even better. How would we even know today? It's so hypothetical. It's so abstract today to sit down and think, well, this could be this and that could be that. And these guys would do this. I studied under a guy named Fekete, and he had a hexagonal model of capital markets. And it's all really interesting, and a lot of it's got historical evidence for it. What would it really be in a free market? Let's have a free market and find out.
Yeah, you and I definitely see eye to eye on this. That is almost exactly my view. And I've always said that I don't, not always, but more recently, within the last 3 years and whatnot, I've said I don't really think the Fed's balance sheet matters that much as far as quantitative easing and quantitative tightening. I don't think it has a causal effect with stocks going up, because in the 1990s stocks went up to a greater degree with no QE. So I don't know how you can somehow say that it was definitively QE that made stocks go up, let's just say in the 2010s. And so a lot, and then I'll say that I don't really think the Fed controls the dollar. I think that they, control overnight rates in the United States, but I don't know that that in and of itself is quote unquote controlling the dollar. Because what that implies is they control the amount of currency units that are circulating in and outside of the United States. And I don't think you can, I mean,
Definitely not outside, for sure.
absolutely not. Absolutely not. That would be the banks in the Eurodollar system and whatnot. But my point there, so people will come back at me and say, well, why do you think, if they're not that big of a deal, why should we end the Fed? And I always say because they bail out the system, and that creates these economic distortions that you're talking about. And I always do this thought experiment where I go back to the early 90s or the mid 90s, and I say, what if the Fed would not have gotten involved with the bailout of long-term capital management?
Right.
If they just would have let them fail, fine, so be it. And the Fed didn't technically bail them out, but they were part of the process. And, it kind of just led to this attitude that the bigger we get, the better, because then we can take as much risk as we can, because we know that we're going to get bailed out. And this just creates this moral hazard that you're referring to, and this crazy incentive structure. And then we compound that with bailing everyone out in 2007 or 2008 and 2009. And then we make it even worse with what we did during the cerveza sickness, in 2020, to the point now where you have to think about this. I mean, we criticize, and I criticize the bankers and all kind of the Wall Street types as well. They deserve criticism, but you have to say, well, what if I was in their shoes? Because basically the incentive structure they have right now is lend into the financial system, buy your own shares back. Whatever you do, do not take any risk by growing your company. Because if you just financialize everything and grow your balance sheet that way, then there's a greater likelihood that you're going to reduce your downside risk. And so the risk reward has totally skewed towards financialization as opposed to the real economy. But that didn't necessarily have to do anything with QE or the QT. It had to, there's a step before that. And what was really important in my view was the bailouts. If they would not have bailed anybody out, then I know we wouldn't have had QE. But I think that's the most important part of the equation. That's why we need to get rid of the Fed.
It's the perverse incentive. And to your point about the Argentinians not being stupid, I don't think the bankers or the public company CEOs are stupid either. They're responding to the incentives that are, put on the table. It's like, do you want to make billions this way, or do you want to risk everything and make millions the hard way? Well, no, I'll take billions risk free. Right. One of the questions, I've got a shareholder and a client who's also a good buddy, and he's registered investment advisor, and we play golf 3-4 times a year, and we're always talking about, it always comes to the same topic, which is, why has the spread between junk and treasuries not blown out? We've been talking about it for years. Right. So before interest rates hike, so Powell was at 2022 says, okay, we're going to start hiking interest rates. And so I guess we've been up for 3 years now. Something like 20% of all corporate debt outstanding was zombie debt. And zombie is defined as when profits are less than interest expense. You literally can't afford to even service the debt, let alone repay it. 20% before we hiking interest rates. Now, all we did is we went from, the Fed funds rate being zero effectively to being 5.25%, 5.5% in a matter of, a few months. And what that did is that moved the margin up. And so all these companies that hadn't been zombie, when rates were zero, now suddenly zombie, at this rate. And I don't know what percentage it is. I've not seen an updated graph. Perhaps they're burying it. They don't want to publish it and show how bad it is. But it have to be at least 50% of corporate debt, maybe more, is zombie at these interest rates. And you would think in a rational market that all of that zombie debt would be junk, and it would be trading at huge spreads to treasuries.
Right. No,
we're
I
talking
know where you're going with this. Keep
two, two,
yeah, keep going.
2,000 basis point spreads, 5,000. Like this should be like Greek CDS back
Yeah.
in 2012, right? But it's not. It isn't. And so, every time we're teeing up, usually it's the third or fourth tee. We, chewed the fat. We talked about other things, and now it's like, what is going on with the junk to treasury spread?
Mm-hmm.
And so, one time, this is I don't know, probably going back a year, close to a year now. He said, "I think I have the answer." He was talking to the back office people in a insurance fund, and basically the regulator had given them the green light to buy, right? So everybody has to recapitalize. Higher interest rates means all the bonds fell in value, which means the asset side fell, and suddenly everyone needs to be recapitalized. Well, it's easier to recapitalize at 7% yields versus 4% yields, right? Or eight versus 5, or whatever it is. So they were given the green light to buy junk with kind of a wink, wink, nudge, nudge. No one said there's a bailout, but if everyone is doing it, of course there'll have to be a bailout if it blows up.
Right. Right.
So they're buying all this junk that they wouldn't have been buying, but the regulator. So normally, if you're an insurance, pension fund, or anything, you have to reserve capital. You can use leverage, but you reserve capital for each asset you buy, depending on the risk of the asset. So if you're buying like 1 month T-bills, there's probably no capital reserve requirement for that. You're buying 30-year treasuries, there is a market price risk, as Silicon Valley Bank found out. And if you're buying junk bonds, there's not only a market price risk, but there's also a default risk. So you have to reserve a lot of capital, so you can't get a capital adjusted rate of return higher than, or very much higher than T-bills. But if the regulator says, no, you don't have to reserve the capital, then you can buy all the stuff. And so it's those institutional balance sheets that have been buying up, junk paper. And it's like, is that going to end badly? Yeah, of course that's going to end badly. When is anybody's guess? I don't know.
Yeah, but your point there, Keith, is it's a massive misallocation of resources. It's massive malinvestment. And the reason they're doing that is because they think they've taken out the default risk. So
and
default
perverse incentive due to the moral hazard of
because the bailout,
the controller of the currency, the Fed, the Treasury, and the whole complex.
Go back to 2020. What did the Fed do? They basically bought corporate debt through they didn't do it directly, but they basically did it through special, what do they call them? Special purpose vehicles, I think.
Yeah.
So all of these pension funds, I mean, they're behaving rationally, where if they can get a 5% interest rate on corporate debt and 4.5 on a treasury, they'll go ahead and take the 5% all day long, because based on what the actions of the central planners, there is no difference between the credit risk or the default risk of a treasury and a corporate bond now, because they know they're going to get bailed out.
Yeah, so it's a perverse incentive.
Yeah.
And call it moral hazard. So that's, yeah, we need to absolutely end that, because perversely incentivizing anything has no good outcome in the end. Yes, your cronies love it. They're feeding at the trough and getting fat and loving it. But other than that, there are no winners, only losers. But the losers are not aware of their losses until years later. And so, politically it flies.
Yeah.
And, anyways, I think we're in violent agreement.
Yeah, for sure on the banking and the moral hazard there that's created by these bailouts. And at the end of the day, we've got a lot of problems, that's for sure. But I would argue that is our biggest. We have to go back to free market capitalism. And contrary to popular belief with the young people today, capitalism is not bailing out the banks. Capitalism is not bailing out AIG. That is the opposite of capitalism. The total opposite. So we got to go back to the real. And that's why, that, Keith, that's why I always say stand up for free market capitalism. I always use the term free market capitalism, and I try to avoid using the term capitalism, because free market capitalism explicitly illustrates my view that it's not just private ownership of property, it's also a free market where you allow entities to fail.
Very good point. In the system proposed by Benito Mussolini, there was nominally private ownership.
Right.
Right. In contrast to the system of Lenin, where nothing was private, but in fascism, it is nominally private. However, the government controls everything. So if you can bail it out, you can also regulate it. They do both. And banks aren't just regulated, they're supervised. They actually have government employees that have to house in their offices who have the right to snoop into any email, walk into any meeting, tell them, don't buy this asset, buy that asset, allocate this way, not that way. They're supervised, which means they're totally under government control, like U.S. Steel apparently now is going to be going forward. They can't make a move without, the approval of the president. And that, yeah, it's private ownership. Someone's going to get rich off of that, but that's not, and I agree with you. The word capitalism has a lot of, it's overloaded. People interpret that to mean a variety of different things, which it isn't. I tend to like to use the term laissez-faire capitalism, which means the government just leave us the hell alone. Don't try to help us. I'm here from the government. I'm here to help. The most infamous words ever, right?
Keith, I know we're running a little short on time, buddy. I want to ask you, I'm going to completely change the topic and go back to what we were talking about at the beginning of the conversation, because I wanted to ask you about gold miners. I know that because when I'm thinking about what I call the catch-up trade, gold goes first, and then silver and the gold miners catch up and exceed the percentage increase in gold. We talked about silver, but what's your view on the gold miners? Do you think they're going to catch up and exceed the percentage price increase that we've seen in gold?
I'm not sure I would say exceed. I think there's two things going on with the miners. One is, we'll call it psychological, and the other is, call it Lucy pulling the football from Charlie Brown. After the 18th time of pulling it, Charlie Brown, well, of course, in the comic, he never, gets sick of it, but in reality, right? So the problem with the miners that they've had is, they haven't generally responded well to the Fed's cycles, on either side, right? So the price of gold is going up, one part of the cycle, but that's the time when the price of all the other inputs is also going up. So they don't have, in dollar terms, either as much increase in profits as you'd expect, or maybe not even any increase in profits at all, because the cost spiral. Then the price of gold comes down, and they're not good at ratcheting. Milton Friedman argued wages are sticky. I mean, there's 1,000,001 reasons, but they haven't been good at managing on either side of the cycle. And so if you look for 30 years, they've underperformed gold on both the way up and the way down. It's been pretty bad. Now this time I do think is different, in the sense that here we are with gold at $3,400, and now oil's just had a big spike because of Iran, but we had oil in the 60s. Whereas by the traditional metric, oil should be in the 200 or 300s, with gold at 3,400.
Right.
So, but the other thing is, it's kind of like Pavlov's dogs. It's the same reason why retail in the West, it's very different here in Dubai or in Turkey or in India or in Asia. But here in the West, retail's not been buying for at least the past 12 months. And as the price continued to go up, retail was actually selling, either to take profits or they needed the money or whatever.
And to be clear, Keith, you're talking about retail selling gold, not gold miners.
Yeah, gold. I'm sorry. Yes, gold and silver, but especially gold. So they just haven't really loved this rally or believed it. And I think I'll call it Pavlov's dogs. But how many times from second half of 2011 through 2019 did you get a blip, and all the usual suspects came out with their emoji icons of rocket ships taking off to the moon and so forth, and just the price would go up, just stay up long enough to sucker everybody to buy, right? And the price would come back down. And there I was saying this rally is not durable, and I have pictures of my basis chart over and over. I did that scores of times during that period, and people called me a perma bear, and I'm like, I'm not. Anyway, Pavlov's dogs have been trained. Yeah, the bell's ringing. do this. This is the right thing to do. And so I think that's why they're not participating in the gold rally. And likewise, the miners, I think there's just a sort of incredulous sense of disbelief. Like, really? Is it really happening now? It can't be happening now, you know? And because if people really believed that, yes, this, you know, price is durable with oil and labor being where it is, then sure, you should buy the miners. And if you look at, you know, some of the miners, I mean, they're building up, you know, really nice cash flows now, right? So from a value play perspective, they're better than they have been in a very long time. All of that said, the caveat I should give is, number one, I can't give investment advice. And number two, I am far from an expert analyst in anything equities, let alone, you know, gold mining equities. This is just my observation from afar. I don't have gold miners in my portfolio for the most part. Because of what I do, I end up with a few things here and there. But, you know, this is just my observation, just saying, I think there's a psychological component, and I think there's a track record, which is real. But I do think the cycle is different because input costs are not skyrocketing the way they had in you know, previous cycles.
And do you think this? So you were the quote unquote perma bear regarding gold.
Oh yeah, Google my track record of all those years of 2012 to 2019. I was not having any of it.
But so now you're not bearish. You're bullish on this cycle for
gold. I'm bullish on gold. Yeah.
Gold itself. So why are you bullish on this cycle? Does it go back to your what you're saying at the beginning with fiat currency?
Well, part of it is, I mean, the fundamental price of gold has been above market for a while. But even leaving that aside, yeah, I see people buying gold, more people buying gold than in the last cycle, and for what I consider to be better reasons, or at least reasons that are likely to be more durable. If it's 2009 and you hear somebody at Freedom Fest say we're going to have imminent hyperinflation by the end of the year, some very famous person said that. I don't really want to, you know, pick fights or name names, but anybody there would know who it was. And if that's your reason for buying gold, you're going to be selling it sooner or later because it's not going to happen. Right. And I wrote at the time, look, hyperinflation is not happening. This isn't how the system works. And today, I don't think anybody's saying hyperinflation, therefore buy gold. I think they're buying gold for a bunch of other reasons, which are better reasons. And I think they intend to hold those gold positions, you know, durably. I don't think, I mean, sure, a lot of people can be in it for a trade to flip it, and nothing wrong with that. But I think a lot of people are buying it just to hold it, and they're not even thinking about its price.
Yeah, it seems like the major buyers so far have been the central banks, and it's not like they're doing it for a short-term trade. And I would argue that I don't think they're doing it because they think the dollar is going to crash or anything like that. I think they're simply doing it because it has no counterparty risk. And in today's day and age, that's what these big central banks, and I think everyone, needs to be most cognizant of and most leery of.
It's a counterparty risk, absolutely. And yes, more and more people are cognizant of that. Now, in Turkey, people are buying gold because the Turkish lira does potentially have hyperinflation, coming either sooner or maybe, you know, middle term. In India, I don't think there's hyperinflation. It's just always been a shit currency. Sorry, I have a lot of Indian friends, but they all know it, right? I mean, nobody in India seriously thinks of savings in rupees.
Right.
It's a currency, you use it to go to market, but that's it. And China, they're buying gold as kind of an anti-Chinese government, anti-yuan play. It's really only the Arab world that you could argue is an anti-dollar play. Now, the Arab, currencies, like here in UAE, they have the dirham.
It's pegged, isn't it?
Yeah, these currencies are pegged, but unlike various banana republics in Latin America, the pegs here are stable. You look at the UAE dirham, and it's been a while. I can embarrass myself here, but last time I looked, it's like 30 years. It's flat as a table. These pegs are durable. Nobody here has to seriously worry they're going to wake up in the morning and find they've lost 50% of the value of their savings. But, number one, there's no particularly good reason to hold your savings in local currency when you could just as easily hold it in dollars. It's one-way risk, right? I mean, it's not like the local currency is going to go up against the dollar. but it could go down. But if you look at what the U.S. government is doing, and they like Americans here. I mean, I feel very welcome. People are very friendly, not just here, but other countries, Gulf countries, Bahrain. They like Americans. They like America. Most of these countries have big U.S. military bases, which I think overall they like, because it gives them a stability. There's a lot of U.S. money that flows here. They like that. And it protects them from their enemies, otherwise they'd have other problems. But they look at U.S. monetary policy in particular. A lot of talk, but I think a little bit overplayed, a lot of talk of how, the U.S. government confiscated Russian assets. And, could we be next? I don't think anybody in UAE seriously has to think that their treasury bonds are going to be, confiscated or anything like that. But I think they look at U.S. monetary policy and, they feel like they get the short end of the stick. I have a very, very sophisticated, I mean, you think all family office investors are sophisticated, but there's degrees of it. And some of them are not that sophisticated, have a lot of money. Some of them are very, very smart. And this one guy said, we get the short end of the stick because we have the stable currency, but we don't have the low interest rates to match. Right? So the interest rates can be a lot higher. That's how they maintain the peg. And if you want to maintain a peg, something has to give. It's either your interest rate, capital controls, or, the peg itself, right? And so it's the interest rates that gyrates around, and that gyrating interest rate kills them. And it's a much higher interest rate, which, I wouldn't say strangles, but stifles, growth of the economy. So it's like, yeah, we're getting the short end of the stick of this. And when people begin to perceive this, yeah, they're angry, they resent it a bit. And, it's slightly sticking it to the man kind of mindset, plus just hey, there's risks here, and even if we can't understand and appreciate all the risks, we should have some gold, or have some more gold. And so people, build their gold positions here. In the, we have companies that lease gold from us that are jewelers, retail jewelers, with showrooms here in Dubai in the gold souk. And for every American, if you have a chance to get to Dubai, do come. You should see it. It's absolutely first world infrastructure, first world everything.
Yeah, I've been there. I've been there many times. And by the way, if you're there, Keith, I don't know if you've been out to the dunes, but take a trip out to the dunes and do the dune buggies and everything. They're awesome.
That sounds like a lot of fun. Anyway, people should also come and see the gold souk and just see the amount of activity. So it's jewelry, and it's not like crappy, cruddy stuff. It has designs. It has an aesthetic to it. It's sold by weight. This is monetary reservation demand. Like, so when everybody breaks down like gold by coins, which they realize is bullion, and then jewelry is a different category. But this jewelry, this isn't Tiffany's or Kay or Zales. This is heavy, heavy stuff. I picked up this necklace. Several of the jewelry stores. This was last summer. I don't know what it is now. I haven't been here on this trip. Advertising 0% making charge. So I went in to see if that's true, and I converted dirham to dollars and grams to to ounces, troy ounces. Yes, they were selling jewelry for spot gold, and then there's a 5%.
So they're buying for under spot.
No, I think they were actually blowing out some inventory.
Okay.
Cycle in the jewelry industry. But anyways, I picked up this necklace, 89.5 grams. It's like 3 troy ounces. I'm holding this in my hand, just feeling the weight of it. I said, the poor woman who's going to wear this, it's going to be like Frodo wearing that ring on his necklace. By the end of the movie, right, he's got this bloody welt on the back of his neck. This thing was heavy, and that was not the heaviest piece by any means in that, in that store.
Yeah.
People are buying this stuff. They're not wearing this around, day to day. They stick it in a safe somewhere. But it's anyway. So there was a lot of fear at the end of Ramadan, as the holiday of Eid or Eid. I don't know how you say it. And it's traditional for them to buy gold as gifts or whatever they do at that time. There was a lot of fear amongst the jewelers with gold at a record high price at that moment that buying would dry up, because that would be the normal pattern. Like in years past, higher price. It's a price sensitive market. Indians are price sensitive. Chinese are price sensitive. It's the Western traders that are momentum chasers. In the East and the Middle East, they're price sensitive. They like to buy when it's cheaper. Anyways, there was record buying, even though the price was high. So yes, the price was high, but people were that eager to dump their currency for gold. And that's, there's just a different, I guess the Elliott wave people would tell you that every market is characterized by kind of a psychology. The psychology has changed. It's not what it was from 2011 to 2019.
Yeah, that makes a lot of sense. Can you do me a favor? Just go over your business model briefly. Just give us the Reader's Digest version and explain it to me like I'm a golden retriever, as they say on Twitter.
Here, boy, food. The irony of, Brent Johnson and I talk about this a lot, that, because he makes this point that if you buy gold, you can't make any money on it until you sell it. Yeah. And I thought, okay, maybe that's a great way to explain what we do, is you have a way of having your cake and eating it too. You can have your gold and make money on it without selling it, because in this environment, people don't want to sell their gold. That's the whole point. It's not like the price went up $100, now I sell it. I want to keep the gold because the dollar is shit. That's why the price of gold went up. Mm-hmm. But how do I make money in the meantime? So we accept, accounts from, retail depositors, and we put the gold to, we offer an interest rate on gold, which is 4%, which means if you give me 100 ounces, at the end of the year, I give you back 104 ounces. That's what 4% interest means. And we do that by leasing the gold to a number of industries, one of which is retail jewelers. So you walk into these stores. These stores are different than what you'd see if you go into a Zales or Kay in the US. Those stores, the gold is very fine, very delicate. It's art. If you see something that has a diameter of ½ an inch, it's not a solid piece of gold for ½ an inch thick. It's either a C shape or it's just a hollow tube, and with very thin walls. The gold here is solid, heavy stuff. The average jewelry store here, a small format store, would have 50 kilos, 1,607 ounces of gold in the store, which is $5 million roughly at today's price. And so that has to be financed. And so what we do is we use the our client's gold to trade for that jewelry. So now the client owns the jewelry, our clients own the jewelry, and the jeweler is paying a rental fee to have all that inventory. The inventory turns relatively slowly, but you need to have a lot of it. You have a very high fixed cost in the jewelry business. You're in the high rent district. You have very expensive fittings, fixtures. These are multi-million-dollar interior fit outs, with the leather and the granite and the, all the halogens and display cases. You have a lot of labor standing around, a lot of marketing costs. You get X number of people to walk in the door. If you don't have the style that they fall in love with in the size that fits, you lose that sale forever. Right. So they want to carry as many different product SKUs as they can, and they want to carry every size so that they can have the perfect fit for the perfect style, and that person then drops, thousands of dollars to buy that. So they need to be stuffed to the gills. If you see one of those display cases, which is, 2 meters wide, let's say, it's bracelet. It's hundreds of them. Yeah, right. In there on those little, fingers that hold the bracelets. And so that's what we do, is we lease them that gold, and we pay.
But why is that an advantage to them? Why would they want to pay you to lease gold when they already have gold in their inventory?
Well, they have to finance it somehow. I mean, if this was copper is $4 a pound. You just buy it and you don't sweat it too much. Gold at $3,300, and it's $5 million there. And these jewelers have tens or hundreds of stores. Right. It's a huge finance need. And their choice is to finance it with equity capital, which is very expensive and very precious and very limited, or get a bank loan. But now you have this mismatch. You borrow, let's say, $5 million. You buy $5 million worth of gold inventory. If the gold price drops 10%, you have a $4.5 million asset. You still owe $5 million. You're insolvent. Right. So you have to hedge, which means borrowing 25% more, putting that in an account, shorting gold futures. If the gold price goes up, you get a margin call. Now, all these guys got margin calls in 2024 because the price was going up. So they're very appreciative of the nature of our product, which is it's hedgeless, and it fits the, the inventory there's no liability. The inventory is now owned by a third party. They're paying a simple rental fee on it. They expense that. If they're borrowing dollars, they'd have to pay interest on it anyway. So it's not like it's free either way. And it matches, the business perfectly. Lets
They
them.
don't have that FX risk because they're borrowing gold and then paying you back in gold.
Right, exactly. So we raise gold from people who own it. We put it to work. People get paid 4% interest on the gold, which means they're making money. We're breaking Brent Johnson's rule. They're making money on their gold without selling the gold.
Right.
And it's perpetual, right? You can do that again next year and the year after. It's sustainable forever. It's an annuity if you want it.
And
So
then
that's what we do.
And then basically the reason these jewelers are willing to pay the reason the jewelers are willing to pay for that is because it provides them a very needed service. That's really the bottom line, because that's the, most of the questions that I get is like, okay, well, how can I go from having to pay 2% or 1% or 50 basis points to store my gold to actually getting paid for it in gold? And that's the answer, because that gold is being used to provide a service that these jewelers desperately want.
Yeah, I mean, the jewelers all know where the elasticity is. Like if you add more inventory, you make more money to a point, and then you sort of hit a saturation level. You're not going to get more customers. And they all know what that is. They're all measuring their business with reasonably sophisticated, ERP systems, and they're looking at their data. So they want to stuff the store full of the right amount of inventory, which needs a lot of finance. So you're either borrowing dollars and taking that FX risk, or you're leasing gold and keeping it off balance sheet and not taking the risk and not have to worry about hedging it. And so the lease fee makes sense because it enables them to make more money.
Yeah.
They have more inventory.
That makes sense. And even if you're not interested in Keith's business or anything like it, it is a very fascinating, it's a fascinating business model, and one that I didn't even know existed. But anyway, thank you very much for sponsoring the channel, Keith. I appreciate it.
You're welcome.
Thanks for walking us through the model and explaining it to us. I wanted to just have a conversation today, first and foremost. I wasn't expecting to dive into all the free banking stuff, but I thoroughly enjoyed it. I thoroughly enjoy our conversations. So appreciate your time. If people want to find out more about Monetary Metals, I think we've got a link. They can go to monetary-metals.com/gammon, I think it is. Or if they have further questions, I assume they can just call the company, and you guys have a customer service representative that kind of just walk and answer any other questions they might have. And I think what I'll do for the editors is, I don't even know if you know this, but I did like a whiteboard explainer video on the business model. And so I'll have the editors to go ahead and put that in the description. If people are interested, they can go ahead and check it out.
I remember that you and I spoke before you produced that video.
Yes,
so thanks for doing that.
Yeah, because I wanted to make sure that I really understood the business model, because it is a little complex, and I don't think it's something that people just intuitively understand why they can get paid in gold for storing their gold. But once you go through it, like, oh, okay, I get it now.
Yeah, it seems like having your cake and eat it too.
Yeah.
And, the world's a funny place. I mean, one of my thought processes before starting the company was that there's a lot of places where you have like a real gold, like a gold bar. And what we've done is we've wrapped it with green wrapping paper. And everyone says, oh, well, this mining company has $1 million worth of net income, or this is $100,000 worth of gold, or whatever. And I'm like, tear off the paper. Let's just see it for the gold that it is.
Right.
But now that's a paradigm shift. And my last company was also a paradigm shift. The company, we made a voice over IP technology. That's why I said, boy, am I familiar with Windows, audio problems and the Windows control panel and the mixer and all that. Everybody has their own, just my little aside, everybody has their own private hell. Mine is that 20 years ago, we saw all the problems of audio on Windows for, voice communications and all that. We solved those problems. We filed patents for them. We built real technology that worked. And that was sold to Nortel Networks, which went bankrupt. The pieces were sold off to Avaya, basically, which dropped it on the floor where it's rotting today. So I literally solved all of the voice audio problems that plague the world today, including I have to suffer with the problems I solved and patented 20 years ago. That's my personal hell.
And the
But
backstory there, guys, before we went live today, Keith was having audio issues with his computer. And so that's what he's talking about. He solved those issues in an entrepreneur 20 years ago, but they still haven't made it to marketplace due to incompetence.
it's just a comedy of various. But anyways, it's a paradigm shift. And when you have a paradigm shift, you're saying to people, look, bear with me. Just imagine the world as it is right now. But imagine if we rotate it 89 degrees, okay? Can you bear with me? People are like, yeah, okay, I get it. And then say, now imagine that would imply this, and this would imply this, and all these things. And people say, yeah, but really it's no, I can't go with you. I can't really picture that, because the world would be a different place if that were all true. And picturing how the world could be different, that's what entrepreneurs try to do, with varying degrees of success or not so much. And saying, okay, what if you rip the paper wrapper off the gold? That's one of those things. It's an 89-degree shift of the world. So I think what we do is really simple. The jeweler needs a bunch of gold inventory. Well, we lease that inventory to them. It's really simple. But for people that are thinking and trained, if you go to Google Images and you type in money, I want to search for pictures of money. It will be page after page after page of paper with green ink on it. And no pictures of gold coins will be found if you search for money. Even though historically that would have been understood, but that's now like esoteric lore. That's not understood anymore. Right? So all this seems very complicated and very, and you got to rip off the paper and say, okay, look, it's just gold underneath, just ounces. That's all it is. Okay, so our investors give us 1,607 ounces, and we lease that and put that in a store in the form of jewelry. So the investors allow us to change the form. We swap, one form of gold for another. They understand they're not holding gold Krugerrands or gold Eagles. They're holding jewelry. As long as we can verify and prove and ensure that the jewelry has that many ounces of fine gold, by weight, then it's fine. And we can always, in worst case scenario, we can get the jewelry at the end and say to the investors, well, you could have gold bullion, or actually the jewelry might be worth more to you. And here's pictures of it. And, or worst case scenario, we melt it down and turn it back into bars, which is easy enough to do and cheap. So I don't think it's complicated at all, but I do appreciate your explainer video, because I think you have a real knack for explaining things in a way that people get it.
Thank you, my friend. I appreciate the kind words. On that note, it's probably midnight where you are, if not later. So I'm going to let you go, buddy. Thanks again for your time, and I can't wait to talk again soon.
All right. Take care.